Hi, it's Mel here, owner and founder of We're Accountants. Today we're going to talk about a very important subject, which is how to extract money effectively from your business. We're going to go through the 3 key points about why it's important to plan out how you will take money from your business. I've got a couple of slides to show you, and then we'll go through the tax efficient money distribution matrix and talk about the different options. And then at the end, if you want a copy of the matrix, I can organise for a copy for you as well. Okay, so I'm just going to share my screen with you. Okay, let's get started. So the first key point to understand is that the money isn't yours. It belongs to the business. It's separate to you unless you're a sole trader. And whilst you do have access to the business bank account, you have to be careful. And the reason you have to be careful is because if you're taking profits out of the business, then you're going to have to comply with the tax laws and there may be more tax to pay. You can't take the money out tax-free. The biggest challenge I've found with business owners is a misconception that because their business has money in the bank and the business is up to date with their ATO payments, they think they can take the money out of the bank because the tax has been paid. Now, that's true. There has been some tax paid to an extent, but there's usually going to be some more tax to pay at the personal level when you access those business profits for personal spending and personal use. Now, perhaps you've put some money of your own into the business to get it going or to prop up cash flow. And if this is what's happened, then you can repay that money to yourself and that's fine. There's no tax payable on that. So the next thing that you need to do is to plan out how you're going to pay for your daily life. So this is your cost of living expenses. So what you should be doing is taking a regular payment, whether that's each week, each fortnight or month. You should know what amount of money you need to pay for your daily life. If you don't know, then you'll need to prepare a personal budget so you can work this out. So you'll be taking your regular payment from the business bank account and moving it into a personal bank account. And then what you need to do is use that personal bank account to pay for your daily life. You need to keep it separate and keep it clean. That will also help you minimise the time that it takes to process your accounts and for your accountant to do your end of year compliance as well. Now, if your business is set up as a sole trader or partnership, then you're going to be taking drawings. If your business is set up as a company or a trust, then you're probably going to be taking wages. This is a simple and effective way of getting money out of your business, and it's also good to be able to show that you've been properly remunerated for working in the business so that if you ever need to apply for bank finance, you'll be able to show that regular income coming out and going into your own bank account. Now, if you're taking wages, there will be super payable on those wages. Many business owners believe that they don't have to pay super on directors and associates' wages, but that's not right. You definitely do need to pay super on wages to yourself and family members as well who are taking wages. If you're taking drawings as a sole trader or through your partnership, then you don't need to pay super. Okay. The next thing that you need to do is work out how to plan for your larger withdrawals. So you need to make sure you plan for any larger withdrawals to make sure you minimise your tax. There could be many reasons why you need to make a larger withdrawal. The first thing is that you need to ensure the business has sufficient cash reserves to allow you to do this. Reasons why you might want to do this are that you could have been building up profits in the business, and when you hit a target, you get to reward yourself by taking some extra money out. This could be quarterly, 6 monthly or 12 monthly. This might be something you plan to do regularly, or it might be because of a one-off need that you've got coming up. The other thing is that you might need to take some money out as a short-term loan. So let's have a look at the matrix and talk through the options. Now I'm just going to change the screen that I'm sharing with you. Okay, so what you can see here is in this matrix is that I've got the different business structure or entity types going along here, along the top here in this row. We've got sole trader, partnership, company, and trust. And then the top section here, we've got how the business income is taxed, who's taxed on the business income, and the tax rate. And then in the below section, I've got options for getting the money out, whether that's wages, distributions of profits, or loan and drawings. So let's have a talk through each of these ones now. So let's talk about drawings first. So if you're taking drawings as a sole trader or partner, it's a straightforward way to get money out of your business. It doesn't need to be reported to the ATO, and it isn't subject to withholding tax or super. Now, whilst it's simple to take drawings, I found that it can lead to some confusion with business owners because they're expecting to be taxed on physical drawings they've taken out of the business. But in fact, they're taxed on the profits in the business, even if they haven't been able to take out all of those profits. So just be aware of that. Now, the next option I'm going to talk about is wages. They're another pretty simple but effective way of getting money out of your business. Often business owners don't stop to reflect how much time and energy they put into their business. Now, this can add up, and it can be rather substantial when considered in the context of a market salary for a similar role in someone else's business. Now, wages aren't an option for sole traders and partners in partnership, as you can't pay a wage to yourself, but it is possible for these businesses to pay wages to other individuals. Now, apart from unrelated employees, there may be someone in your family, perhaps your spouse or a child, who also does work for the business. And you can pay them provided the wage is commensurate with their input into the business. There's nothing preventing you from paying a wage to someone in your family. One thing to consider when deciding to pay wages is that there are a number of on-costs associated with that, including superannuation guarantee, workers' compensation, and potentially payroll tax as well. All right, now let's have a look and talk about loans. Providing a loan can be simple as well. And in many cases, you might not even realise that you're taking a loan. Anytime the business provides you with cash or other assets of the business that haven't been attributed to you as either wages or a distribution, then you're effectively taking a loan from the business. People often refer to this as taking drawings from the company or from the trust. Now, loans from your business can be formal or informal, and many business owners will have loans going to and from their business that are informal, and more often than not, they're interest-free. There's quite often money coming in and money going out, and it's an ongoing cycle. Now, loans can be okay, but they can also land you in hot water from a tax perspective. And before going ahead and borrowing money from the business, you should always check whether your partnership agreement or trust deed or company constitution or shareholders agreement allows you to borrow from the business and that the loan is properly documented. You should also talk to your accountant to make sure there are no adverse tax consequences, especially if you're borrowing a large amount. It's really something that you should talk to your accountant about so that they can plan ahead and plan around that. If you've got a company or a trust, then you're probably familiar with Division 7A and also Section 100A, which are two hot topics, and they're anti-avoidance provisions, which affect loans and drawings in companies and trusts. So if you have that structure, I would urge you to talk to your accountant and make sure you're across that. So just talking about all of those different options, you can see as well in this summary here as to what's available to you depending on your business structure. So sole trader and partnership don't have as many options, whereas the company and trust, you do have a few more options with how you can take that money out, but you just have to be aware that there can be adverse tax consequences. So you really need to make sure you're planning around that. Okay, I think that's a wrap for this session today. If you'd like to get a copy of my tax efficient money distribution matrix, then please type that in Facebook or in the link below. And if you'd like a hand or you'd like to go through this, depending on your business structure, so you understand properly how this affects you, then please give me a shout. I hope you found this useful, and that's all for today. I'll catch you next time.